Unit 2, Activity 3 goes over how to account for bad debts. In a perfect world, all of a company's creditors would pay their debts. In reality, that doesn't always happen. In this activity, you will explore how to account for uncollectible accounts receivable. I'm sure if any of your families own a business, you've heard family members talking about people who don't pay their debts. Well, in accounting terms, we get to write those people off as bad debt expense. On the balance sheet, each of the major types of receivables should be identified in the notes, or in the notes to the financial statements they should be identified. In the balance sheet, short-term receivables are reported within the current asset section and fall below cash and temporary investments. Both the gross amounts of receivables and the allowance for doubtful accounts should be reported. The term receivables refers to amounts due from individuals and other companies. They are claims expected to be collected in cash. The three major classes of receivables are accounts receivable, notes receivable, and other receivable. There are three primary accounting problems associated with accounts receivable. You need to know how to recognize accounts receivable, how to value them, and how to dispose of them if they're not paid. When recognizing accounts receivable, financing charges are added to a balance owing. Accounts receivable is debited and interest revenue is credited. When a business sells merchandise to a customer on credit, accounts receivable is debited and sales is credited. I think most of you know that, and we would also at this point account for sales tax, but to keep it simple, we're leaving sales tax out of this. When a business receives returned merchandise previously sold to a customer on credit, sales returns and allowances is debited and accounts receivable is credited. When a business collects cash from a customer for merchandise previously sold on credit, cash is debited and accounts receivable is credited. This, of course, is review for all of you. To ensure that receivables are not overstated on the balance sheet, they are stated at their net realizable value, which is the net amount expected to be received in cash and excludes amounts that the company estimates will not be able to collect. So when we estimate that there will be a certain percentage of bad debts, then we need to record the net realizable value, not what the original accounts receivable were. A business estimating what accounts are going to be uncollectible is just that. It's just an estimation. There are different methods to do this estimation. One is called the direct write-off method, and the other one is called the allowance method, and I will be explaining both of these. The direct write-off method is not acceptable for tax purposes, but some businesses use this just to see what is actually happening in their business. Under the direct write-off method, no entries are made for bad debts until an account is determined to be uncollectible, at which time the loss is charged to bad debt expense. No attempt is made to match bad debts to sales revenues or to show the net realizable value of the accounts receivable on the balance sheet, so therefore does not follow GAAP principles and is not acceptable. The journal entry for a company using this method for their own purposes is to debit bad debt expense for the amount that is uncollectible and credit the accounts receivable to take them off the books. So in this example, Pierre Company writes off E. Schaefer's $200 balance as uncollectible on January 12th. When this method is used, bad debt expense will show only actual losses from uncollectibles. It is not an estimate. One method for estimating bad debts is called the allowance method, and it is required when bad debts are deemed to be quite a bit in amount. Uncollectible accounts are estimated, and the expense for the uncollectible accounts is matched against sales in the same accounting period in which the sales occurred. Therefore, this method follows the matching principle. An example for the allowance method is as follows. Estimated uncollectible are debited to bad debt expense and credited to allowance for doubtful accounts, a contra asset account at the end of each period. Remember, a contra asset is an asset with a credit balance. The balance sheet presentation is to list accounts receivable less allowance for doubtful accounts, and their net realizable value in this case is $188,000. When it is for sure that these accounts will not be collected, then the journal entry to write off the person's account is to debit allowance for doubtful accounts and credit accounts receivable. to take them off our books and recognize the amount we didn't get from them. When there is a recovery of an account that has been written off, so we assume a person is not going to pay us, and then all of a sudden this person comes into some money and they end up paying us, it requires two entries to record it. One, you have to set the accounts receivable back up. So you reverse the entry made to write off the account. So you debit accounts receivable and credit allowance for doubtful accounts. And the second entry is to recognize the cash that you received from the person and credit accounts receivable to write them off your books. When companies use the allowance method for estimating bad debts, there are two different ways they can calculate the amount they estimate will be uncollectible. The first one is the income statement method, where you take a percentage of sales, and the second method is the balance sheet method, where you take a percentage of receivables. Companies, usually based on their history of uncollectibles, will decide to use one or the other of these methods. Both of these methods are fine for GAAP, and it's as I said, a management decision which one they use. When comparing the two methods, percentage of sales closely matches sales and bad debts, but percentage of receivable closely matches the net realizable value of accounts receivable on the balance sheet. So I guess in the first one, the income statement is a bit more accurate, and in the second one, the balance sheet is a bit more accurate. For the income statement method, the management establishes a percentage relationship between the amount of credit sales and expected losses from uncollectible accounts. Expected bad debt losses are determined by applying the percentage to the sales base of the current period. So this percentage they estimate is usually based on history. If they know on average they lose about 2% of their accounts receivable, 2% of their sales, then they would use this as the percentage they're using to estimate what will go bad this year. This basis better matches expenses with revenues. Under the percentage of receivables basis, management establishes a percentage relationship between the amount of accounts receivable and the required balance in the allowance account. This percentage can be applied to the total accounts receivable balance or to individual accounts receivable balances by age. And again, this amount that they're estimating is based on the history of what has been uncollectible in the past. The percentage of receivables basis required balance in the allowance account is determined by applying the percentage to the accounts receivable balance at the end of the current period. This is key. The amount of the adjusting entry to record the expected bad debt losses for the current period is the difference between the required balance and the existing balance in the allowance account. In Unit 1, you had a worksheet where you estimated bad debts, and you had to take into account the amount in the allowance for doubtful accounts when you were doing the adjustment. This basis produces the better estimate of net realizable value of receivables. A lot of companies, when they're having trouble collecting their accounts receivable, they will sell some to a finance company or bank, or some people just won't take accounts receivable. Some businesses will only allow credit card sales so that they can be, guaranteed that they will get their amount owed them. And so when they're trying to get rid of their accounts receivable, they sell them, as I said, or they only make credit card sales. A finance company buys receivables from a business for a fee and collects the payments directly from the customers. Also, credit cards are used frequently by retailers who wish to avoid the paperwork of issuing credit. In the content of this lesson, there are examples of calculating bad debt expense, and so go over these examples carefully. Using the balance sheet method or for allowance and the income statement method, and let me know if you have any questions. Good luck with activity 3, everyone.